Unfortunately, we're in uncharted waters here. There's a lot of confusion and uncertainty around the impact of the coronavirus on the economy. We've seen the impact it's already had in markets. You've seen the terrible human toll. And we do agree that it won't be a rapid snapback. It will take several quarters to crawl out of it. And a lot of that, unfortunately, will depend upon whether the virus boomerangs back in the fall, which no one really knows. So our outlook would be acute pain now, but not nearly as bad as the financial crisis, which is a very key point. The biggest risks to SkyBridge portfolio have been and still are a bear market or acute economic contraction, i.e. recession. Unfortunately, there's been no way to make money the past 2, 4, 5 years without at least living with some risk, and that's been the one we've been willing to live with. Fortunately, coming into this, what is now the first bear market since the financial crisis, we cut some of our equity risks that we had in the portfolio, and in general have been very defensive. We've been primarily long consumer and commercial real estate that's been backed by multifamily properties. The consumer has been in very good shape and should be somewhat resilient, even if unemployment goes up to 4.5 or 5, like it could potentially do. Commercial real estate maturities aren't due till 2024 to 2025, so default risk is very low there. And we've also been long community and regional bank credit, where even though their stock prices are under tremendous pressure, their credit quality is pristine. It's the best it's been in over 2 or 3 generations. On the short side, our primary exposures have been tied to corporate credit, both investment grade and high yield. We knew at some point, whatever caused the dislocation, high yield and investment grade would be disproportionately punished because that's where you've had the most excesses in this cycle. So we'd like to think we've been long assets with strong fundamentals that are admittedly going to deteriorate if we have a brief economic contraction. And we've been short assets that have horrible fundamentals that are now getting clobbered because of the downturn in the economy, unfortunately. But the reality is, when you go through a bear market, if equities are down 30, 40, 50%, they haven't hit 30 yet, but they got very close, you're going to be down. Our goal is just to be down materially less and put ourselves in a position to go on offense and take advantage of dislocations that are being created today. Unfortunately, market dislocations are sometimes needed to create the next great opportunity. It's not really limited to one because we're looking at a variety of things, but primarily distressed corporate credit, where you've had tremendous widening in high yield and investment grade bond spreads. We may play that through cash bonds or through CDS. We're also looking at ramping up macro exposures now because it's a tremendous opportunity to trade the volatility in various asset classes and ultimately get meaningfully long equities when we come through this. Additionally, we think this is a great trading opportunity for macro managers. Furthermore, we think ultimately most technology companies that have gotten bludgeoned by a sell-off will come back, as well as healthcare. So those are some of the areas we're looking at to add risk over the next 2 to 4 weeks. Fortunately, there's no limit to the opportunities now. We just have to be very selective in what we go after with the best fundamentals and then the most upside, not if, but when the economy turns the corner later this year. We know we're not going to time a bottom. No one does. But if you're not starting to incrementally add risk in this environment, when will you? Look, at SkyBridge Capital, Mission 1, protect capital. Mission 2 is to take those dislocations and turn them into opportunities to generate attractive returns in the next 6, 12, 18 months. The whole reason institutions and ultra high net worth and now accredited investors have embraced hedge funds in their portfolio is to grind out a consistent return that's hopefully competitive with fixed income and equity markets or somewhere in between, but do it in a way that has far less volatility. Years like last year, we underperform equities, but years like 18, we outperform. Years like this year, we outperform. We think over time, we'd like to put up a competitive return to equities, but do it in a way that isn't nearly as volatile and doesn't subject your portfolio to the wild swings and material losses like we've seen this year.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Multi-Advisor Hedge Fund Portfolios Series G and the SkyBridge G2 Fund, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.